Hi, Jane and John. Welcome to your financial plan. I wanted to let you know that I've reviewed all of the information that you provided and developed your initial plan and projections. So I'm excited to talk to you today. I have added to our portal a few files that summarize the projections, that address the specific questions that you posed, and map out key planning opportunities. In this video, I wanted to walk you through these documents to keep things easy to digest. So with that in mind, I'm going to share my screen. And the first document I'm going to be looking at with you is the document entitled Financial Plan Intro Letter. And so I just sort of wanted to walk you through this. Wanted to note first off, you have really built a great net worth and a strong income. That's going to make things a lot more, give you a lot more options in what you're able to do for your future. The plan that we put together is a starting point. As we are going to be working together, we're going to refine those projections. And below in the document here, you will find requests for some additional data, as well as key planning opportunities. Our goal is to make sure that we are leveraging your resources in service to your vision for what you want in your life. Okay. The plan is a little dense with information, and not all opportunities are created equal. So some will be more time sensitive than others and more impactful than others, and we do not have to do everything at once. So we're going to break down the recommendations, and when we meet, we will review prioritized steps to achieve everything we're trying to get done. Okay, thanks again for sending ahead those questions. That was helpful. So here, under what questions do you have for us? I'm just going to say I've added some questions throughout this document, but in this first section, I wanted to include a list of documents that would be really helpful if you could provide. Our goal, now that we have an initial snapshot of our plan, will be to make sure that our numbers are all fine-tuned and that we can fill in any gaps. And so the documents that you see listed here, it would be very helpful if you could add those to the Dropbox. If you start doing that and that seems onerous and it'd be helpful to hop on a call to do that together, I'm happy to do that. Just give me a shout. Okay. The next question is the money question. How long do we have to continue to work until we can retire with the same income? Okay. So as we previously talked about, because you have a great income and a great net worth, you are going to have options as far as that is concerned. I'm going to, in a minute here, I'm going to switch files, and I'm going to show you what your initial plan looks like. I want to let you know before we look at that together that there are a number of levers available that we can pull and adjust these numbers up or down. Okay. There are a number of decisions that you'll need to make that will adjust these numbers. This is simply an initial view of where you are based on some assumptions that I put together. Okay. So let me pull that open. Okay. So first off, you did note, I saw in your paperwork that you believe you have a low risk tolerance. So I put together some recommended portfolio for you. Essentially, I have you in a somewhat balanced portfolio prior to retirement. You see the breakdown here. At a high level, it consists of about 50% bonds. It has about, just under 5% in cash. It's always good to have some cash available, and the remainders in stocks. Okay. Once you get to retirement and you reach retirement age and you retire, then recommend you move into a little bit more conservative portfolio. So you'll see that here. Instead of 45% in stocks, this has you about 28% in stocks. So this is during a time period where you don't have as much income coming in, and it's more important to make sure that you are maintaining the capital that you've worked so hard to build. At the bottom here, you'll see a graph of what an average returns for this portfolio looks like. Okay, so the bottom part here is your taxable accounts, and the top is your qualified accounts. So you'll see that based on average returns that, you know, at the end of the plan, which I've designated to be when John is, we extended John's expected plan to age 94 and Jane's expected plan to age 96. So when Jane is 96, we end the plan, and with average returns, you should have about 500K remaining in your portfolio at that time. Okay, so when we start talking about running retirement projections, nothing is ever specifically according to average, right? So there are a number of scenarios that could play out. We estimate conservatively, okay? So we take a look at historical numbers, and we inform those with forward-looking projections that are more conservative. The reason for that is, I'll take bonds, for example. Historically, we have had periods of very high return for bonds that we are not apt to see in the future, in our lifetimes. And so we incorporate the advice of those who study this all the time and have just built in some more conservative projections. So we run the retirement projections. We run a Monte Carlo. I don't know if you're familiar with that, but I will show that to you in a moment. And what that does, it essentially runs, you know, it assumes, what if you lived your life 1,000 times? And it runs 1,000 trials based on those projections. And it calculates what is my confidence level based on those 1,000 times we run that. How many times will my plan be successful? Okay. A trial will fail if you are $1 or more short, actually 1 cent or more short. You know, if you're 1 cent or more short of what you need for your projections, okay? And so let's take a look at what your Monte Carlo looks like. Okay, this is it. When we run a Monte Carlo projections, we never receive 100%. I like to talk through this a little bit because those clients who are used to getting, you know, who are superstars like yourselves and are used to performing, often you go in thinking, well, I would like to get an A. I would like to get 100%. Monte Carlos do not produce 100% confidence levels. The highest you can get is 99. And if you're planning at a 99, then you're really leaving money on the table. Okay. We have to remember that in reality, we're going to put some guardrails in place. Okay. So in those situations where perhaps the economy does go through more difficult times than were predicted, and we have even something like a depression, then we're going to make adjustments for that. Really, you're not going to spend as much in discretionary spending as you would, you know, if that did not happen. And so we make adjustments along the way. Plans are never one and done. Okay. So our goal in with this is to get somewhere in the 70% to 90% confidence zone. 80% is precisely the sweet spot. Okay. So I wanted to show you what the plan comprises of. It basically shows John working until age 64, Jane working till age 62. So retiring together at those ages. The dollars that I show here, basically for basic living expenses and discretionary spending, is intended to maintain your same level of maintain your same standard of living. Okay, so you currently have a I know you said you would like to maintain the same income. In reality, when you retire, there are going to be some expenses that naturally fall off. For example, one day your kids are going to be done with school. It may not seem like it right now, but that is true. At some point, your mortgage will be paid off for your home. So there are some expenses that naturally fall off. What I've modeled here is maintaining your same level of discretionary spending. And so we've built that in. I've put in college. I know you asked about education. I've put in projected college expenses for each of the kids. Basically modeled what it would look like to fund 4 years at a public in-state school for each of them. And we've assumed that your medical expenses will be transitioned to Medicare. Okay. So like I said, that plan gets you to 64 and 62. Okay, I'm going to go back to the letter here. Okay, so this talks through some of the things we've just spoken about. The assumptions that I've made associated with that plan are that education expenses are going to end 4 years after 4 years of post-secondary education for each kid. We talked about current medical expenses transitioning to Medicare. I've made an assumption that you remain in your current home and that you retain ownership of John Jackson Enterprises, continuing to receive distributions. So those latter two things are items that you will need to make a decision about, and that could potentially inform the plan. Okay, so if you had an interest in pulling your retirement date earlier, or adjusting it so that you're retiring at different times, anything like that, there's lots of levers. Okay. So more importantly, we'll want to make sure we're discussing your vision for what you want your retirement to look like. So I've put some questions in the letter here. These are things that we will have an entire meeting to meet and talk through. But I put them there so you can start thinking about them now. Okay. And then on the nuts and bolts side of this retirement funding, we will want to evaluate additional tax advantaged retirement savings options that are available to both of you. I did note that you both have an IRA, but I specifically would like to evaluate what other employer provided and for John business tax advantaged retirement savings we can look into. Okay, next question. How should we fund our kids' retirement? So I'll go to this, we'll go through this one pretty quickly. Education funding is definitely going to be an immediate planning priority. I note that your kids are in private school and also that your oldest has just graduated and potentially may be considering some sort of post-secondary education. And so that'll be an immediate priority for us. 529 plans are really great, a really great option. So they can be used not only on college, but also for trade school and K through 12 education. So beneficiaries can be changed between the siblings. And not only that, but it used to be that there was a concern about over contributing to 529s. Under current rules, up to 35,000 of unused 529 funds can be rolled over to a Roth IRA for the beneficiary down the road. Okay. So that's a big benefit. And we still want to evaluate how much we want to put in there, but that's going to be a really good vehicle for us. For this upcoming school year, I suggest that you continue to cover the tuition out of cash flow. And if you need to pull some additional funds for college for your oldest, then you can always pull from your money market. Okay, so I recommend that for this next year's tuition, which is probably due momentarily. And then we can establish the 529 accounts, one for each kid, in parallel with that. Okay. Okay, some additional information here about setting those up. And then we can super fund those also. We'll talk more about that when we meet. But essentially that involves accelerating up to 5 years worth of gift tax exclusions into a single year. You could do that out of your taxable brokerage account. Okay. So that would essentially allow you to move up to $190,000 per kid into a 529 to jumpstart that tax-free growth. Okay. And then just a note that we'll want to thoughtfully consider what we intend to fund for education following high school. Okay, next question is, what would be the planning that you need to do pertaining to John's business? Okay, so first off, I want to say big congratulations. I saw the financials on your business, and that's really exciting. Thank you for contributing to America's small businesses. I see you have quite a good revenue and $240K in annual distribution. So that is a big part of your household income. I took a look to see what the approximate value of the business would be, and I use a formula that's just 3 times earnings or 3 times EBITDA, if you know that. This business is really an asset. It provides current cash flow and a valuable opportunity for continued income if you choose to keep it during retirement. Approximate value of the business is around $720K if you do choose to sell it at some point in the future. Okay. There are a number of opportunities you have here. So first and most importantly, let's take a look at establishing a 401K. Okay. That will first and foremost allow you guys to take advantage of more pre-tax investments for your retirement. And also it's going to be a good thing to have for an employee benefit. Makes it really attractive for an employee benefit. Okay. I want to take a look to consider establishing a buy-sell agreement and a key person insurance policy. That makes it such that if something were to happen to John, there'd be a clear plan laid out for the shop to either operate, transition, or be sold. Okay. We want to evaluate whether business reserves are sufficient to buffer against contingencies and cash flow fluctuations. So you'll see that some of the documents I've requested up above are related to your business. It's in order so that it could help with that. And finally, we wanted to evaluate what the exit strategy is. Do you intend to keep this business after retirement in order to have those distributions? Or would you rather be done with it and divest of it either by transferring it to key employees or, selling it outside? Okay. And then your final question, what should we do with Jane's company stock? So Jane, much like I shared with John about his business, you have done a great job with your career. You have a very lucrative career at XYZ, and that equity compensation is really a significant part of your income, of your total comp package. Okay. A concern is that holding a large concentration of XYZ stock does carry substantial risk. I think particularly given your you sharing that you have a low risk tolerance, we want to evaluate that in terms of, divesting of it as soon as it makes and moving it to a more distributed portfolio as soon as is wise to do so. Okay. It's worth noting that if something goes bad at XYZ, it has the potential to impact both your career, and these additional investments. So we want to move it over, as I said, when it makes sense, to a diversified portfolio. Okay. So what I'd like to do, I found that a lot of the clients that I work with who get equity compensation never receive really training on or education on how those work, and it's really can be really complicated. And so what I'd like to do today is I've added one of the documents I've added to the share file is just a brief summary. I'm going to pull it up here. Okay, here it is. So what I'd like to do is I'd like to just walk through this just to give you a cursory understanding, if you don't already have it, and you may, in regards to how each of these items of equity compensation work. Okay, so first, the stock options. So those refer to non-qualified stock options and incentive stock options. You have incentive stock options, which is awesome. Stock options give you the right to purchase shares at the strike price after vesting. Okay, so they grant you the ISOs after they vest, which means you have the right to have them. You're able to purchase shares of the stock at whatever strike price is designated. Okay, and then so if the market price has risen above the strike price, you're essentially able to buy the stock at a discount. Okay, they call it a bargain. So ISOs have favorable tax treatment. There's no tax owed when you exercise the option. Okay, they are exempt from income tax if you meet special holding period rules. That's how that differs from the NSOs. Okay, you have to hold the shares for 2 years from the date they were granted, at least, and at least 1 year from the date of exercise. Okay, if you hold those, then you owe no income taxes. Okay, otherwise, income taxes are going to apply to that discount or bargain element when you sell them. Okay, there's another bullet here about how that factors into alternative minimum tax. We're not going to talk about that today. When you get ready to sell these, let's talk about it in detail, and I'd like to have you consult with your tax professional, okay, so that they can evaluate what the potential impact is to AMT. Okay, and then next is restricted stock, which is comprised of RSAs and RSUs. Okay, so those are actual shares that are given to you that are subject to a vesting schedule. Okay, so you have both of those, RSAs and RSUs. So RSAs you probably had earlier on with XYZ, and they're actual shares that they award you when they grant them. Okay, so you get the voting privileges and all of that stuff. And then if you don't meet the vesting requirements, then they would take them away. Their tax is ordinary income when they vest. And there's a special eligibility for what's called Section 83B. If you take that election, it allows you to pay taxes on the whatever the value is when it's granted. Okay, so that can be a big deal, but you have to file it within 30 days of the grant. So the question for you on the RSAs that you have is going to be, was that filed at the time? And did you already pay, therefore already pay taxes at the time? Okay. Then RSUs are typically issued later on. So those are you've probably received those more recently with XYZ. And those are promises to provide shares later when they vest. Okay. Their tax is ordinary income when they vest. Okay. So each of these is different. Again, I like to just give a little context before we talk about what I advise you do with it. Okay. Okay. So, let's see. So here I have laid in the file, you have this file in our portal. Okay. So this lays out each of the equities that were listed and then the information you provided. Okay. So I'm not going to walk through all of these now. Okay. But this is here for you. What I'm going to do is I'm going to go back to our intro letter. Oops. Okay. So, like we said, the important thing is to systematically reduce your holdings in that single stock concentration and move those funds to a conservative, more diversified portfolio. Okay. That helps protect you from the downside risk if that stock drops. Okay. And here's how I would approach things right now, given that the stock price is $30 per share. Okay. So first off, we talked about, gifting or selling vested RSUs and RSAs. We need to consider the tax impacts. Okay. And we're going to systematically exercise and liquidate the ISOs that are in the money. Okay. So those that have a strike price under the market price. Okay. We talked about the special holding rules. We talked about AMT. Okay. We're going to hold and monitor the ISOs that are underwater. An important thing that I wanted to mention here, an opportunity, is the opportunity to leverage your appreciated shares for giving, charitable giving. Okay, let me put that there. This is for charitable giving. So I noted that you have a generous heart and you give $50,000 annually to charity. By gifting appreciated shares directly rather than cash, you can eliminate the capital gains tax while satisfying those charitable goals. There's a little bit more on that in planning opportunities below. And then we want to, so anything you want to gift, you get big advantage for that. Anything that you do end up liquidating. If you decide to gift it, don't liquidate it first. Just gift the share, just to make sure that's clear. And then any cash proceeds from liquidated shares, we're going to put into that diversified portfolio in your brokerage account, your Schwab brokerage account. I've noticed some additional key planning opportunities here. I'll let you read through this, but essentially, I have some questions related to your rental properties. I saw some amounts you referenced there. I wanted to know the expenses listed for your rental properties, whether or not those are reflecting a negative net cash flow from those properties. We'll definitely want to review opportunities to improve the cash flow and evaluate the return you're receiving, because you have $500,000 invested in equity for those rental properties. So we want to make sure that you're getting a good return on those. Okay. And decide how they fit in your overall financial picture. Because we need to evaluate whether or not some changes may need to be made. And also, I noted your monthly primary residence expenses seem quite low relative to the mortgage debt on the home. And so I wasn't sure if that intended to include the mortgage payment. Some of the documents I've asked for up above is the mortgage documents. So that'll help ensure that we have precise numbers for each of those. Okay, insurance, you've done a great job insuring in areas that people often miss. We noted, or I will note, that the homeowner's premium was $1,200 a year. That seems really low for a $3 million home. So let's make sure to review that insurance policy to make sure we have adequate coverage. Okay. Saw disability and long-term care policies for John, but not for Jane. I'd like to just talk with you guys and understand if that was intentional. It may be worthwhile to evaluate adding those coverages for Jane. And also term life insurance. I didn't see any term life insurance, but I think we definitely should evaluate whether or not that's needed. Okay. So we talked a little earlier about tax efficient charitable giving. We also might explore setting up a donor advised fund. You may have heard of those before. Those essentially allow for tax-free growth, and you can claim a tax deduction in the year you contribute, even if the money is gifted to the qualified charity in a later year. It allows you to bunch your donations for tax deductions. So it can be a really powerful vehicle that can really help optimize the value of your donation. And then finally, an area that I address with all of my clients is estate planning, because that can have such an impact when, in critical times. Okay, so some of the documents I'd ask you to provide are those documents. Let's make sure that everything is up to date. In addition, because Jarius is now 18, he is an adult. And so in order for you to be able to step in and help him when there is a medical or a financial emergency, there need to be documents in place for that. So we can take a look at that. Gosh, we've covered a lot in this initial summary, and this video got to be a little long. So we covered a lot. I want to just reiterate that we do not have to tackle everything at once. Okay. I would ask that following this video, if you would please just take a look at the documentation in the portal. Take some time to absorb it. If you have any questions, note them, and then we'll get together and discuss all of this. So I don't want you to think you have to rewatch this video and try to make sure you catch things. We will be able to talk through them. Just note any questions that pop up. And if you have an opportunity, please do provide any documentation you're able to from section 1 up here. Thank you so much. I'm really looking forward to being on this journey with you, and look forward to seeing you next week. Talk soon.